Our assessment of this move in silver in particular is that it's going to a new reality. I can give you umpteen long-term verbal reasons why,
Okay.
charts included. I think silver's going into several $100s, may even go as
Okay.
high as 500, and I think it will do it by summer this year. These accelerated moves in silver, even the ones that occurred in that compressed 50-year, half-century antiquity range that surged up to $50, they occurred in a couple quarters where silver went ballistic and reached the top of that range. We're no longer dealing with that range anymore. But some of the same technical metrics that signaled the onset of those orgies on the upside in silver, where it had already been going up for years and suddenly goes berserk, was a spread relationship between silver and gold. Silver is still vastly undervalued to gold. If you go back 50 years and look at the surges in price that occurred in silver, like 79 to 80, look what the spread of silver versus gold was then. In other words, divide an ounce of silver into an ounce of gold. Back then it was 6.5%. Okay, keep that in mind.
Hmm.
Then in the 2010-11 final 7-month surge of that multi-year bull market, silver broke out versus gold on a spread chart now. You didn't see it looking at the price chart. Price was going up, both of them going up merrily, but that spread broke out and that announced verticality for silver that lasted a couple of quarters, just like the other one, 79 to 80. Silver went up double and a half in 7 months, but it was still confined in that 50-year range, which was sort of silly given the degradation in the money unit. If you factored where silver ought to be now versus 1980 high at 50, it probably should be $500. In fact, I think that's about right. And if you measured it against the 2011 peak when silver was 50, in that surge, again in the box, its spread was 3.1. Right now, silver is only 2.1% of the price of gold, so it's still cheap historically. We're arguing that not only has silver broken out of its range and likely to have an orgy on the upside that mostly gets done within a couple quarters, counting again from the November close last year. So December, January, we're only 2 months into this couple month thesis.
Hmm.
Uh, that the spread might just do what price did, namely take out the highs of the last 50 years. $50 silver, $50 silver, that's gone. Okay, fast. Why not challenge the relative performance highs because silver is still cheap? Why not challenge 3%? Why not challenge 6.5? Price took out those highs. Silver's still cheap. Maybe its spread will also reach those levels. You do the math on what silver, if continue gold up, what silver might be at 3% or 6% of an ongoing bull trend in gold. It takes you off the page.
Wow.
Another metric here. Now, pardon me for going too long here.
No, it's all
If
good.
you
It's all
look,
great.
if you look at an idiot price chart, arithmetic scale, go back to 75. You've got that range that was like from $4 lows to $50 highs. So, call it a $50 range or a $45 range. And if you see a price range like that and you break out, the orthodoxy of price analysis is to, take the thickness of the range and add it to the range. That's your swing objective.
In this video, silver is projected to hit $500 an ounce this year, but this is only the beginning. Micheal Oliver reveals why the $56 low in silver was a bear trap and why momentum never confirmed the breakdown. With the Fed poised to unleash epic money printing to stop a bond panic, the era of particle precious metal spike is here. The breakout in silver versus gold and silver versus S&P signals a massive assets flow shift that most investors are completely missing.
We've been bullish on gold since February of 2016 when gold came up off its December 2015 low at
Hmm.
1,050. At 1140, we said, okay, major upturn. We'd been bearish from 2012 through 15, by the way. But we had annual momentum breakout. And when you looked at a price chart back then, you just another staircase low. and you barely turned up off of it. But when you looked at momentum, you saw something different. Anyway, but the point is that that long-term metric of measuring the trend direction of gold, for example, or silver, has not broken down since then. It's continued to rise in layers, but nothing technically has indicated that that bull trend that began 10 years ago is over. And then now you're reaching the phase, though, in the bull trend where you're no longer doing the arm wrestling layered advance, which has, bored the heck out of gold investors for the last 10 years and frustrated silver investors because you go up and then you have this 1 year wide range and then you go up again and you have a correction and it's arduous. We reached the point late last year when the relative performance of monetary metals versus the US stock market said no more. We're now going to leave the earth compared to you. We're leaving you behind. And that's the point at which it's indicating at least an initial shift by normal portfolio managers, fund managers that are saying, hey, Morgan Stanley said 60-40 is no longer good. It's now 60%, 20% bonds, 20% gold. And that was a huge intellectual admission on their part that the old reality was wrong. And that UST bonds are not, the other alternative, that the stock market instead gold is. I disagree with their weighting, but at least it was an admission. Well, some money has started to flow and you can measure it. You can see it.
Okay, wait, I got to interrupt though. So
Go ahead.
what do you think the weighting should be? Higher?
Oh, it probably should be 80, 10, 10. Okay, gold. Okay. No, there's times when gold should be at the front. Okay. And we're at that point now where it's outperforming even the bubble US stock market, which is one of the strongest stock markets since 2009. US stock market's been among the strongest. China's not a bubble. It's only about double where it was in 2009, but we've gone up, S&P's gone up 11, 12 fold. NASDAQ 100 has gone up 20 plus fold since 2009. So measuring gold against them it's a harsh measure because it's a strong market, strong stock market, and yet it's beating it, indicating somebody punched a hole in that dam and the water's starting to flow out.
Okay.
It's going into money. Okay, so that's just begun though. That's the point. Is that just began? So people who are talking about, well, it's almost got to be over because it's vertical. Silver, gold, vertical.
Yeah.
On arithmetic charts it is. But they're wrong. The game really just began where the real water flow into the monetary metals has only just been signaled. So the more accelerated price phase where that money flows into what really is a fairly small sector, especially the gold and silver miners.
Right, tiny. Yeah.
That it could be, a huge impact on the verticality of those markets. Those spread relationships, meaning it's a relative valuation chart of the ounce of gold divided into the S&P 500 price. And we went back to 2013 and on that chart, and you could see that basically over the last 11 years, gold has wandered sideways in value to the S&P, ups and downs, but basically contained. So you could call it a par performer. Meaning, it depends on when you bought gold, you're doing better than the S&P, sometimes worse, but basically sideways in performance over that 11 years, which very few investors had acknowledged, but it was a fact. Anyway, that chart had a very clear ceiling on it. And you could draw for like 4 pivotal highs that bumped this line, okay? And late last year, they closed above it. Monthly closing was October, November. And since then, what happened is gold has surged in relative performance to the S&P, well up out of that base. But the net price of gold has also gone quite vertical. Okay. Same thing happened with silver shortly. I think it was the same month, actually, where it had a basing type relative performance to the S&P. A little bit more declining than gold had been over the last 11 years in terms of its valuation to the S&P. And it broke out and it exploded. Okay. So the spread chart was a technical metric. Let's see something. I'm going to do some math here on my calculator here. Yeah, okay. We use the XAU index because it goes back to the 1980s. gold
Mhm.
and silver miners it contains, Philadelphia Gold Silver Miner Index. And if you look at it in the 80s, 70s, no, excuse me, the 80s, 90s into 2000 and 2008, it was in a range of relative readings to gold, meaning what's the price of XAU divided into gold? And it oscillated for decades, either side of 25% of an ounce of price of gold, ounce of gold. It got up to 35% one time. It got down repeatedly to 17, 18%. But the midpoint of that range was 25%. Okay. You broke through that in September of 2008. Isn't that cute?
Hmm.
In other words, the miners broke down relative to gold a month before the crash occurred in the S&P and the month in which the miners got really dumped on.